Should alternative investments have a place in your portfolio? I'm Jack Otter, editor of Barron's.com. I'm here with Valerie Newell, who is founder and chairman of Riverpoint Capital Management. So Valerie, there's been a lot of talk about alternative investments. It's a catch-all, but basically people hope that with bond yields virtually nil, with stocks fully valued, that this black box will give me great returns. You say I should step carefully in that regard.
Absolutely. I'm a trustee of several foundations and endowments, large ones. And over the last 5 to 7 years, these kind of institutions have put a lot of money into these kind of hedge funds, absolute return funds, long-short equity strategies. And the bottom line is that they really have not worked out, Jack. If you look at the numbers, they've been very disappointing. We thought that they were going to be equity alternatives because, hey, in 2007 and 8, everybody thought the equity markets from here on out were going to be dead. And also the challenge of the interest rate environment. So the fact that these turned out to be very disappointing from a performance standpoint, is really disappointing. And I'm now seeing these institutions moving away from these investments. Now, they had 20, 30, sometimes 40% of their portfolios in these types of strategies. So for the individual investor, I would say, boy, be really, really careful. Very, very high fees. No transparency. And really, you have to do a lot of due diligence to understand what you are really getting when you make an investment in these liquid alternatives or a hedge fund. And so you really need to know what you're doing. And a lot of times they just haven't panned out.
One issue, of course, is benchmarking. What do you compare them to, since they are black boxes in some ways? Are people benchmarking them well?
I don't think they're benchmarking them well at all. What I see is a couple different ways they're doing it. One, they're doing it against other hedge funds, which if you look at this area, it's from A to Z. There are all kinds of different strategies, from global macro to distressed debt to long-short equity. I mean, there's not a lot of similarity between those types of investment strategies, except for very high fees, no transparency. And so when you look at that, you have to really look at the benchmark that people are using, and you can't just use it on a general hedge fund benchmark. The other benchmark that I see being used is one that's almost like bond-like. And when I look at the underlying investment strategies that are used in these hedge funds and in absolute return funds, they are really equity type. We're expecting equity type returns. So why in the world would you benchmark it against anything else? But the people that are managing this, why wouldn't you want to be benchmarked against a bond index?
So I'm not a big fan either, but I'll take their side, play the devil's advocate with you. So one argument is, well, this has been a great period for equities ever since the financial crisis. Sure, we've had some stumbles, but over the 5-6 years, it's been a nice run. So when things really turn south, that's when these things are going to show their mettle and protect you. What do you think?
And that's the argument, but don't fall for it, because the data doesn't support it. Like if you take so far in 2016, the hedge fund universe was down 2%. The market was up almost 2%. So if you look at different areas of time, it's just not working out that way.
One more issue for investors in these things, they can often use leverage, which of course, if things go south, hurts you even more.
Yes, and the problem with leverage is that it's very, very hard for an individual investor to understand exactly how much leverage is being used, what it is being used for. So it's a lack of transparency that you really don't know what you're getting, and that's where I have a big concern with the use of these type of instruments on the individual level. I mean, when you really think about it, a plain vanilla investment portfolio of stocks and bonds, that's a really good situation, and especially when you put dividend-paying stocks in it. It's really a good alternative. You don't need fancy schmancy investments to get good, solid growth in the future.
Valerie, thanks for the common sense.
Thank you.